let's cover lesson 13-4. It says it's advanced topics in financial reporting, and there is serious complexity with these topics. The difference between permanent and temporary differences for net income versus taxable, components of comprehensive income, and non-recurring items on an income statement. This book doesn't even begin to tap into the difficulty and complexity, so I will try to keep it dumbed down for sure and get you only what you need to know. So let's go to net income and taxable income. So all along, everything we have done in accounting 1 and 2 has been to help us compute net income, and you know how to do that. The key to net income that it talks about on this slide is that we follow GAAP in the United States, so generally accepted accounting principles, and GAAP is on an accrual basis of accounting, like you know, which means that we record revenue when it's earned, and we record expenses when they're incurred, as opposed to taxable income. So for the IRS, we follow U.S. tax law for taxable income, and it is on a cash basis of accounting, not accrual. So revenue is only recorded when the cash is received, and expenses are only recorded when the cash is paid. So that's a big difference between the two. So there are really two types of differences that arise as a result of this, and those differences are either permanent or temporary differences. So that's what you need to know. So let's first talk about permanent differences. So as you can see there, a difference between net income and taxable income only for that year, and it never gets balanced out in a future year. It's called a permanent difference. So that's saying that within one fiscal year, it's going to be different between net income and taxable income, how it's treated, and it's never going to catch up by the end of its time, and we'll talk about that. So an example of a permanent difference in revenues is interest revenue on a tax-exempt bond. So if we purchase a tax-exempt bond and we earn interest on that bond, we would include that income in net income. But we will never, because it's exempt, meaning it never has to be included, it will never be recorded in taxable income. So the income related to that interest that we receive will never, ever be recorded in taxable income. So we'll never pay tax on that in the future, ever. So that's permanent, never going to catch up, never going to turn around for us. So that is one thing. The other thing I would add to my notes on this slide is that it also includes cash payments that are not deductible for tax purposes, but are expenses for net income. Okay, so things that aren't deductible for tax, so I'll never exclude or subtract them out of tax income, taxable income. And these things include these four that I would know. Premiums paid on life insurance policies for key employees. I'd record that expense on tax or on net income, never would record it in taxable income. The lobbying and political expenses is the second. The third is fines. And the fourth is half the cost of business meals. It's just a taxing. So they're not deductible, meaning I can't subtract them out of income for tax purposes. So it never comes out of taxable income, those four things. So let's just look at this. This is on page 391 if you want to look there. But permanent differences then. So we're looking at from a taxable income for the IRS and paying taxes under U.S. law, and then for net income for book purposes, book income, what it would be. So our taxable income before this permanent thing happened was 50 grand. We earned some interest revenue from a tax-exempt bond. So it does not get included in income. So the ending taxable income is 50 grand. For net income purposes, we started at 50,000 just like there, but we do include the 1,000 we got and earned from a tax-exempt bond to get to $51,000. So our book income, our net income is going to be $51,000 that we report to shareholders. Our income for tax purposes that we report to the IRS is going to be 50 grand. So that takes care of permanent. So then let's look at the other type of difference. It's a temporary difference, also known as a timing difference, because it'll eventually readjust and catch up is what we call it. So a temporary difference is a difference between net income and taxable income for more than one period that reverses out over the entire period. So once the difference been reversed, the total net income will equal the total taxable income. So it may be $5 difference every year, or $5 that we're recording every year under one method for 5 years to get to 25 bucks. On the next method, it may be that we're doing 10, 5, 5, and then 5 over just 4 years, but in total at the end of the 5 years, they each had $25 is what it comes down to. So that's what they're trying to get at. It's over the entire time period that difference will reverse out. So accrued items is what I would add to my notes. Accrued items are often what leads to timing differences. So again, for expense things, which are typical, the expenses for net income are when incurred, and for taxable income, it's when paid. And certain ones are not deductible for tax purposes either. So let's look at the temporary difference. The first example, page 392, that it gives you relates to insurance expense. And if you recall, for book purposes, let's talk about book purposes here first. When we buy an insurance policy and pay for those premiums, we typically will pay at the end of the year for the upcoming year. So in 2000 X1, when we pay for that coverage, we credit cash, we debit prepaid insurance, which is an asset. So we have no insurance expense whatsoever in that year. Then as we utilize the insurance for book purposes, we do an adjusting entry to show what we use. So if it was for the whole next year, our expense, our cost was $1,000 in X2, even though we paid it in X1. All the expense would be recorded in the year in which we used the coverage. For taxable purposes then, what would happen is that since it's when paid for tax purposes, and we paid it at the end of this first year, all of that would be an expense for that year. And next year in X2, we wouldn't have any expense at all because we didn't pay anything further. So we start at the same income before, and we say whether or not we deduct that insurance expense or not. And so what happens is that for book purposes, I have 50,000 of income this year and 49, a total of 99 at the end of the 2 years. And I had 49 in year 1 and 50 in year 2, still a total of 99. So at the end of that period, those have all reversed and the temporary differences were the same. And income was the same after that time frame. So the other thing that I would want you to add in your notes about this is the one that is typically the largest is depreciation expense. That is the biggest timing difference typically. For net income, we typically use straight line depreciation. to amortize or depreciate that over the life of the asset. If it's 5 years, then we'll depreciate, say, $100,000, and we'll do $20,000 every year to get to $100,000. But under tax purposes, they usually let you do an accelerated method, which means that I'm getting higher deductions and higher expenses, and hence a deduction in early years, and I pay less in later years. So that same asset that I did straight line $20,000 per year, I may do $30,000 first year, $30,000 the second year, $30,000 the next year, and then $10,000 in year 4, so that by the end of year 5, I've still depreciated for tax purposes $100,000. It just was quicker in the early years. So that's kind of how this whole temporary difference thing works. The next advanced topic is comprehensive income. And you have the bullets up there that explain things, but you're aware of things that impact equity, things such as owner investments and dividends and withdrawals and things like that. That is typical things, but there are other changes that happen to equity that are not those kind of typical business things. And for any change that affects it, we have to, for GAAP financial statement purposes, either disclose the comprehensive income in a separate statement of comprehensive income or part of the traditional income statement, meaning we put the traditional one and then just add a little bit more disclosing information about what these items are of comprehensive income that impacted it. So here is an example, and I would just be aware maybe of these 2 items, but don't have to understand how they came up with it. So there's our typical income statement: revenue, expenses, income from operations, tax, to get to net income. A statement of comprehensive income would then take that net income number to start and say other items that affect equity. So comprehensive income. So foreign currency translation and unrealized losses on securities. And then the third advanced topic is non-recurring items on an income statement. And what it's trying to say in these bullet points is at the top of an income statement, you tend to have things that are closely related to the purpose of the company or the operation, and they're more likely to recur every single period. And then the things at the bottom are things that are less likely to recur, and they're less core to the business. They're outside the normal operations. So if we look at this non-recurring items on the income statement, a few things you should know. So all of the stuff that would have been up above to get to income from operations, these are close to the operations and they're likely to recur. Then there's this section on other revenue and expenses. These are likely to recur, but they're not typically closely related to the core part of the operations of the business. And these could include, which I would put in my notes, losses from natural disasters, writing down values of assets, gain losses from a lawsuit, and gain and losses from the sale of investments. And that ultimately, after tax expense, we would get to our income from continuing operations, which we have always done, just as net income. But this is from continuing. Then we have something called discontinued operations. We would do this net of any tax. And there's 2 components. The loss from the discontinued operations, meaning any that I've gotten rid of, the revenue and expense related to them that I'm getting rid of during the year. And then loss from disposing of the assets for that same business or operations. So I would just include any loss or from DO is what it's called. So ultimately then I get to net income of $165,792. So income from normal operations, we're used to. DO is non-recurring and not related to your ongoing operations in the future.